In 1971, the average UK house price was around £4,975. A pint of milk cost around 5p. A weekly shop for a family of 4 came to roughly £5. If you'd put £10,000 in a tin under your bed that year and left it there, you'd still have £10,000 today. The number would not have changed by a single penny, but that £10,000 would now buy you less than a tenth of what it bought you in 1971. No crash, no fraud, no bad decisions. Just time and a force that most people never fully reckon with until it's already done significant damage. Inflation doesn't announce itself. It doesn't send a letter. It just quietly, persistently erodes what your money is worth. And it does it whether you're paying attention or not. Welcome back to the Investor Center podcast. I'm Isiah, and today we're talking about inflation, what it actually does to your money over time, why the savings account you think is protecting you might be doing the opposite, and what the alternative looks like. Before we get into it, head to theinvestorcenter.co.uk for our full breakdown of the best FCA-regulated investing platforms in the UK. All links are down in the description. So let's get into it. Most people grew up being told that saving money is responsible, and it is, up to a point. Having 3 to 6 months of expenses in an accessible cash account is genuinely sensible. That's your emergency fund. That money is doing exactly what it should be doing. But beyond that, the story gets more complicated, because a savings account that pays you 3% interest when inflation is running at 4% isn't growing your wealth. It's shrinking it. Slowly, invisibly, but shrinking it nonetheless. The number in your account goes up. The purchasing power of that number goes down. Those are two different things, and most people only look at the first one. This is something called the inflation trap. You feel financially responsible because your balance is increasing, but in real terms, in terms of what that money can actually buy you, you're moving backwards. And the longer the gap between your savings rate and the inflation rate, the further back you go. Here's a way to make it concrete. According to the Bank of England's own inflation calculator, £1,000 in 1990 had the equivalent purchasing power of roughly £2,300 today, which means if someone had put £1,000 in a zero interest account in 1990 and left it untouched, it would still read £1,000, but it would only buy what £435 bought back then, more than half the real value gone. Not to a bad investment, not to a crash, just to time and inflation doing what they always do. Want something even more tangible? A Mars bar cost around 35p in 2008. Today it's £1.05. Based on historic inflation patterns, that same bar could cost you around £2.50 by 2051. That's not a dramatic economic event. That's just 25 years of inflation doing what it always does, quietly making the same money by less and less. The UK has experienced periods of high inflation, the early 1970s, the early 1980s, and more recently the spike following the COVID era. But even in relatively calm periods, inflation compounds. A consistent 2% annual inflation rate halves the purchasing power of money in roughly 35 years. It is slow enough to feel harmless. It's persistent enough to be devastating over a lifetime. Just a quick one from us. If today's episode has got you thinking about whether your money is actually keeping pace with inflation, we've compared the best investment platforms in the UK so you can see what your options are. The links are down in the description, including some current sign-up offers. So let's get back into it. There's a concept in investing called the real return. It's simple. It's your return after inflation is accounted for. A savings account paying 2% when inflation is 3% has a real return of -1%. You are, in purchasing power terms, losing money. A broad stock market index historically returning around 10% nominally, with inflation at 3%, has a real return of roughly 7%. That's not a guarantee. Past performance doesn't predict the future, but it represents the historical direction of travel over long periods. That gap between -1% and +7% is the entire argument for investing long-term money rather than leaving it in cash. It's not about being greedy. It's not about taking unnecessary risk. It's about understanding that inflation is a permanent feature of modern economies, that it compounds over time, and that cash savings, beyond what you genuinely need accessible, are not a neutral choice. they are a slow loss. The people who have built real wealth over long periods weren't necessarily the ones who found the best stock or timed the market perfectly. They were often just the ones who understood this gap early enough to do something about it, and then stayed invested long enough for compounding to work in their favor rather than against them. So what does that actually mean in practice? Cash has a role. An emergency fund makes sense in cash. Accessible, stable, there when it's needed. Short-term saving goals, a holiday, a car, something needed within 2 or 3 years probably makes sense in cash too. Market volatility is not something you want on money that might be needed next year. But money you won't need for 5 years or more, leaving that in cash means inflation is slowly winning. A low-cost global index fund inside a stocks and shares ISA is the most straightforward way most people have access to returns that can outpace inflation over the long term. Not guaranteed, not without short-term fluctuations, but historically over long enough periods, the direction of travel has been clear. Inflation is not a dramatic story. There's no villain, no single moment of collapse. It just shows up every year, takes a little, and leaves quietly. The best defense against it is understanding that it's happening and making sure your money is working hard enough to stay ahead. This episode has not been financial advice, it's just information, and we hope that you found it useful. If you want to explore your options for investing in the UK, the comparison links are down in the description. Subscribe or follow so you don't miss the next episode. I'm Isiah from the Investor Centre, and we'll see you in the next one.